Hi, everybody. This is Matthew Owens. I'm here to go over with you and a couple of other speakers a little bit about syndicated investments and understanding them, the different investments that work within them, and give you guys some examples of those, as well as just a general overview of what they are, how they work, the different risks involved, how to do your due diligence on them. And I brought a couple of key speakers on the line, Jeremy Roll and Hunter Thompson, that will be talking a little bit with me, and we'll have a discussion about these syndicated investments. And so, at OCG Properties, our goal is to create financial freedom for ourselves and our investors through real estate investments that create a passive cash flow stream. And we invest in a ton of different syndicated investments in multiple markets, in multiple asset classes, and with multiple operators to diversify our portfolios and really develop a really strong cash flow stream. And so I'm going to come on and welcome Hunter and Jeremy here as well and share my webcam. So Jeremy and Hunter, you guys can go ahead and start yours as well.
How's it going, guys?
Hey, how's it going? So thank you
Everyone.
guys very much. And for you speakers, right now you can go ahead and use your split screen right in the middle and make the presentation piece bigger or smaller, so that way you can completely see the different webcams and things like that that are up. So thank you very much for joining us today. I'm here just to kind of talk a little bit about these syndications, and we have Jeremy, which is a full-time passive real estate investor that focuses on these types of syndications substantially and invests in them full-time himself, as well as Hunter, that does the same type of activity as well on the related to syndicated investments. So welcome, guys. Thanks a lot for coming. I appreciate it. Love the headphones, Hunter. That's awesome. From your DJ. That's great.
Yeah, I am using the headphones, but the benefit is that I do have an external microphone, so hopefully the audio quality will sound good on the recording for the
Nice.
investors today.
Nice. Thank you very much. I appreciate it. So, well, why don't you guys give a quick? I'll start with you, Jeremy. Why don't you give a quick overview of who you are and what your experience is?
Sure. Thanks everyone for attending, by the way. Appreciate everyone taking the time. And Matt, thanks for hosting the webinar. My name is Jeremy Roll, originally from Montreal, Canada. I've been down in the US since 1998 and in Los Angeles since 2000. My quick background on syndicated investments is I've basically been investing in syndicated investments since 2002. The main reason that I had to actually look at them is because I was working at the time in the corporate world at Disney headquarters, and I was too busy to go look to acquire properties for myself. So syndicated investments can be a great way to be what I would call a passive investor. And for me, it's all really been about passive cash flow investing. So between 2002 and 2007, I rotated all my money, my retirement money from stocks and bonds into cash flow. A lot of it was real estate. There were some other things too. And 15 years later, I'm basically I became, well, actually 5 years later, I became a full-time passive cash flow investor. So in 5 years, the cash flow got me out of the corporate world actually. And so since mid 2007, I've been focused on finding more and more syndicated opportunities so I can continue my cash flow stream so I never have to go back to the corporate world. So I've been a full-time passive cash flow investor for 10 years, about 15 years of passive cash flow investing. And when I say passive cash flow investing, I effectively mean investing in syndicated investments that generate passive cash flow.
So let me give you a nice little round of applause for getting out of corporate America. You can tell that none of us are in corporate America. None of us wearing ties. So I refuse to wear ties. My brother gives me some flack for it. He says, you're not supposed to wear a sport jacket without a tie because it's not professional. So, but I have to say I'm disputing corporate America going forward, and I have to say that it's really commendable that you were able to do that and get out of corporate America and create a passive cash flow stream that was able to give you the lifestyle that you want, and actually be able to create the different income streams that you want through having enough passive cash flow to really retire yourself. And I know you're not retired, of course, so I've seen your schedule. I know how busy it is, even though I give you a little flack for it. But to be quite honest, it's really, really impressive and something that I think should be commended and something most investors should really strive for is that passive cash flow. The power that it gives you once you have all your expenses covered with that cash flow is phenomenal. And it's probably one of the things that most people should be striving for every single time they invest is looking at how they can cover their monthly expenses with that cash flow.
Hey, Matt, I just want to say that
Yeah.
I just want to say normally I tell people that cash flow has really changed my life, and it really truly has. I don't mean to sound like an infomercial, but it's I kind of am an infomercial in a way, but in terms of getting passive cash flow checks. But when I think about it, it's really not the passive cash flow change, but it's really the syndicated investments that changed my life because they're the vehicles that allow for the passive cash flow that I've invested in over the years. I also want to just point out to everybody that since it's been 15 years, I've made many investments. I've actually made over 100 syndicated investments. Or I shouldn't say that. I've made over 100 investments in LLCs, many of which that have been syndicated, and I'm currently in over about 70 different opportunities. So one of the great things about syndicated investments, we'll get into more details, is that you can get a lot of diversification for a certain amount of capital compared to investing in things directly yourself. So.
Okay. Hunter, what about yourself? Can you give a little bit of overview of your experience?
Yeah, absolutely. So my investment career really changed significantly between 2008, 2009, 2010. That is very common in investment circles, but for me it was a little bit different. So when 2008 happened, I was immediately drawn to I knew that there was an opportunity in investing. There was asset collapses, asset price collapses in multiple different asset classes, and I knew it would be a great time to jump in. I thought at the time that stocks and bonds and mutual funds were probably the best way because I had seen that the devastation that took place. But for me, which is unlike most investors, to me, when I realized that I had to start pursuing low risk, cash flow focused real estate, specifically syndications, which is the topic for today, that was in 2010. And why that is that this is when the European debt crisis really started to take place. And so for those of you that don't know, the European debt crisis has a lot of similarities to what took place in the US during 2008, but it was in Europe 2010. From my perspective, this made me just realize how insanely correlated all this stuff is and how there's no way to truly diversify and get away from having contagion for things you have absolutely no control over, things that are across a huge ocean or several or something like that. So for example, I was watching CNBC one day, and they were saying that if the German bond yields remained below 7%, that the S&P 500 was going to shoot up. And if it went above 7%, the S&P 500 was going to collapse by a couple points. And to me, I was just like, how in the world is any piece of my financial future dictated by the German bond yields? Least of all, how could I predict what the German bond yields are going to do, right? And this is something that a lot of investors are facing, especially if you're a small business, if you don't have 50 employees. How are you able to do the due diligence that goes along with the complexities of understanding some of these companies? So Apple, for example, a lot of people are invested in Apple. Can anyone tell me how many iPads are going to sell in China next quarter? It's unbelievable. To kind of accomplish that would be unbelievable, and people try to do it that have 50 employees, and it's very challenging. For me, one of the benefits of real estate, particularly syndicated real estate, the simplicity of the investment. There is a property. Is it rented? If it's rented, are you making capital? Are you making cash flow? And just to further that, the concept of cash flow and the predictability of rents is so much more predictable and dependable than the valuation of a stock, for example. So that's kind of my perspective as an investor and how I got started. And my strategy is very similar to what you guys both talked about. I focus on syndicated, recession-resistant assets that have lucrative cash flow that's very dependable.
I agree 100% with looking at it from the simplistic point of view. At the same time, it can be very complex as well. And I speak of this as an operator myself because and that's one of the biggest I think benefits associated with syndicated investments is the fact that you can invest passively. Now, granted, there's a lot of due diligence up front that needs to be done, but at the same time, after that due diligence is done, it's much more passive than even a rental property or or a multifamily building or something like that. That you have major decision-making abilities that are decisions that you have to actually make. So myself, as you guys know, I flip 5 houses a month at a minimum. We buy multifamilies. I run a management company, a renovation company, and a real estate brokerage. And it gets pretty complex sometimes from the operations standpoint. And there's things you cannot control involved. I mean, you could do as good of a renovation as you possibly can, and there's still going to be a few things that you cannot help. The things just happen after the fact. Maybe it's because there's a rain or there's another issue that comes up after the fact. And so, there's a lot of different moving factors, and I really love investing passively in syndicated investments because of the lack of work that goes on afterwards. After you do that initial due diligence, yes, you have to keep up with the operators, and you're relying on operators to actually do the homework for you. So not do all the homework, but do the actual operational components of the deal for you. And so it takes a lot of work off of your plate. At the same time, you still have to check in. That means you have to do that much more due diligence on the operator in itself, And so, I really love syndications from that standpoint, where you can kind of put your money to the side or into those deals, get updates on a consistent basis, make some phone calls and things like that. But it's nothing that you're actually having to operate unless there's a problem. And, quite honestly, in this field, there are problems because there's a lot of really bad operators, in my opinion, out there, right? And Jeremy, I know you've seen a ton of these bad operators and bad, deals that you see out there. Can you kind of talk a little bit about what makes a good and bad syndication structure based on your experience and some of the craziness you've seen on some of those syndications?
Yeah, it's interesting because structure, there's actually a few different ways to look at structure for syndication. There's the entity you're investing in. So I've definitely seen horror stories of people investing in tenancy in commons or TICs or TICs. For example, I mean, I know I'm singling it out, but to answer your question, so I could see that if somebody invests in a C corp instead of an LLC or an S corp for flow-through purposes, that would probably be a disaster from a tax perspective, being double taxed. So that's one way to look at structure. But another way to look at structure is actually how the syndication is structured from an investor's perspective, as far as the returns and the preferred returns and other things. So there's the return structure for investors, and then there's also some of the legal, I don't know if you consider this structure, but some of the legal terms involved in, let's say, the operating agreement, the LLC rules, which could cause a huge problem. So when you're thinking about structure, it could be ownership structure. Does someone own 95% of the voting rights or a majority of the voting rights? It could be a big problem for everybody else that's invested. So there's a lot of different components to look at when you're looking at investing in a syndication and the structure, and how a structure could be good or bad. And I would say that for anyone out there who's new to this, there's definitely a lot to learn, and I would strongly recommend that you don't jump into syndication until you really learn enough to know what you're doing, what you're looking at, what you're investing in, because there's definitely a number of things to consider.
And that's one of the biggest reasons why they don't allow everybody to invest in these types of investments. Normally, they only allow, depending on the regulation that you follow, they allow 35 non-accredited investors. Which an accredited investor is someone that has $1 million in net worth, excluding their primary residence, or has made $200,000 a year for the last 2 years in order to invest. Otherwise, you're not considered an accredited investor that can legally invest in these types of assets consistently. Now, that doesn't mean you can't. That means there's a limitation in each individual fund that allows or disallows that. And some funds don't allow you to do it unless you're an actual accredited investor, right?
Yeah, that's right. There's actually, it's interesting because now with crowdfunding, which, by the way, crowdfunding falls under syndications, right? A lot of people don't realize that. They're somewhat synonymous in some ways, and in other ways they aren't. And so there are various syndication structures, or legal structures I'm talking about, from a SEC perspective that you can invest in. And so some of these allow for only accredited investors. And by the way, for those of you who are listening who aren't familiar with that definition, it's when someone asks if you're an accredited investor, they're not asking if you're part of a group or a member of a group. What they're actually asking is whether you fall under a definition that the SEC provides as to whether you have certain minimum net worth or income requirements to work to the point where they're not as concerned about you losing money in an opportunity. Really, that's a lot of what it comes down to. They don't want you to lose every penny you have, so they have certain definitions. So some of the crowdfunding, a lot of the crowdfunding real estate platforms won't allow you to actually sign up unless you're accredited, for example, and that means you meet those certain minimum criteria. Some of the syndications don't allow for any non-accredited investors, and the ones that do, if they're raising $1 million or less, they can typically take an unlimited number of non-accredited investors, but over $1 million, I'm generalizing here just to make it simple, but there's another structure over $1 million, which is the most common one, where they're limited to 35 non-accredited investors. They can take an unlimited amount of accredited investors. And so I don't want to overcomplicate things, but and I don't know if you guys want, I can actually share the definition of what an accredited investor is if you want. Should I do that?
Yeah, go ahead.
Okay, so an accredited investor from an SEC perspective, if you file taxes single, so not joint, then you have to have made at least $200,000 a year for the past 2 years and expect to make $200,000 this coming year. If you're filing joint, then you have to have made at least a joint income of $300,000 in the last 2 years and expect to make $300,000 this year. Now that's the income qualification, or it could be either or you can have a net worth excluding the value in your primary residence, so not including your main home that you own, of $1 million or more net worth. So if you fall under one of those two categories, then technically you're considered an accredited investor.
Okay.
I would say to anyone who's listening that if you're not an accredited investor, it's actually probably a lot less limiting than you would think. I personally have found that a lot of the opportunities that I invest in accept both accredited and non-accredited investors. I think the major exception would be any opportunity that's allowed to be advertised, typically as accredited investors only. And I think all the crowdfunding sites, just from a crowdfunding rules perspective, at least on the real estate side in the way they operate, most or all of them will only take accredited investors. So you won't be able to sign up onto most of the real estate crowdfunding platforms, but if you can find opportunities directly, there's definitely plenty of them out there, and the vast majority of them will accept you as a non-accredited investor if you're not accredited.
Okay. And Hunter, from a return perspective, and can you kind of give an example of a bad or a good structure when you're dealing with the operators getting paid and the investors getting paid, and how that typically works for investors, and what a good and bad structure might be?
Yeah, no problem. So first of all, before we dive into the details, just from a big picture perspective, syndications are usually investments in which people fund to an LLC and they have passive ownership in that LLC. They defer to a sponsor who is typically extremely experienced in this industry, and they've usually done several properties, been doing this for years, and because of their expertise and their specialization, they take a split of the profit that is derived from this opportunity. So there's usually a structure that implies a preferred return to investors. This means that investors need to hit a certain return before this split takes place. This is great for incentive alignment because this means that operators or sponsors are not going to choose opportunities unless they think they are going to make them at least this preferred return to investors, because if they don't hit the preferred return, they don't get compensated. So a really great example of a bad structure is if there's a syndication in which there is not a preferred return. And I actually recently received an opportunity from someone who is involved in the financial sector, but not specifically involved in real estate. And the deal had all the makings of a very poor structure and an underwriting process. There was no preferred return. There was also a lot of, if you want, I can go into some of the underwriting issues that were in the deal. Is that cool at this point?
That'd be great.
Cool. So one of the things to watch out for in terms of underwriting is cap rate compression during a hold of the term, and this had this all over it. They're buying the property at a 7 cap, which is the return that an investor is willing to accept if they bought the property in all cash. Okay, so what that means is if you buy property in all cash and there's a 7 cap, that means they're willing to accept a 7% return for that investment. So that means the lower the cap rate, the higher they are willing to sell, to purchase the property for. So when there's cap rate compression, that means there's an implicit market correction meaning that the value of the property is going to increase regardless of what they do to the property. So that would be an example of a bad underwriting structure. Something to look out also on the syndicated side are fees that are put into the underwriting, or fees that are put into the structure that aren't really brought to light. One of them is an asset management fee. Okay, so this is not related to the preferred return. That's the key here. The asset management fee can be based on gross income, meaning that no matter whether or not the investors make any money, before investors are paid, the manager can get compensated. Again, this is against the preferred return structure, which is very favorable. So if there's going to be an asset management fee, make sure that it's more preferable that the asset management fee is based on income, at least, if there's going to be one at all. And then typically what we see is, depending on the amount of work that the sponsor has to do, the split above the preferred return is usually somewhere between 50 and 80%. 50 would be the kind of thing where the sponsor is bringing a lot to the table. They have years of experience and they're doing a lot. They might value add, they may be even expanding units, building some construction or something like that. They're bringing a lot to the table. 80% would usually be on the side of them buying a stabilized asset and just kind of optimizing efficiencies, which would have much less risk, which would mean they were taking on less of a job, less responsibilities, and therefore the split is less favorable.
And you're meaning splits in 80% in the favor of investors, right? So the investor gets 80%, the operator gets 20% for just basically optimizing a deal that is already up and running and performing well, but there's some inefficiencies and they can increase the value a little bit by doing based on their experience and their management structure.
Very good distinction. That's exactly correct. And it's very rare that the split will be favorable, will be weighted towards the operator side. I have seen it, and we can even talk about something like that later. But yes, when I say 50 to 80%, I mean 50, 80% in favor of the investor.
Okay. And, that brings up a good point. When you're dealing with operators, that's one of the biggest risks associated with these syndicated investments is the operators, their pro formas, and understanding how they work and understanding what's conservative and not conservative. Jeremy, can you talk a little bit about some of the due diligence you normally do on an operator as a whole?
Sure, yeah. So first of all, I just want to say, when you invest in a syndication, just to be clear, you're giving up control, okay? Because typically you're going to be a very small part of a bigger deal, and let's say that you end up being 2% of that deal, all the equity that's raised for that deal, then you're going to have a 2% vote, which clearly won't carry much weight. And so what I like to say is that, I give up control in exchange for diversification. So you're able to put small pieces across a lot of deals, but you give up control. Now, when you give up control, that increases certain risks. Okay, so you have the additional risk of fraud, mismanagement, and other risks that you literally don't have control over on behalf of the operator. Mm-hmm. So a lot of people probably don't think of it this way, but I would say that the most important factor in investing in syndication is who you're making the bet on, meaning the manager, the sponsor. The second most important thing in a syndication is the actual asset itself and what you're actually investing in. And so doing the property diligence on managers is absolutely critical. The first thing I'll say is that background checks is something that most people don't do, in my experience. I would even go so far as to say that 9 out of 10 investors I ask whether they do background checks when they invest in syndications, the answer is no. Maybe, in fact, I had a conversation with some earlier this week, and I was actually surprised to hear that he did background checks, which is really unfortunate because I've personally been saved a number of times just by doing background checks from people who were clearly either fraudulent or had major issues in the past. Mm-hmm. So that's really key as far as doing due diligence. Another thing about due diligence in syndications is essentially what you're trying to figure out is who you're making the bet on, and ultimately the best person you can make a bet on is an experienced person in a specific asset class who is looking to be conservative, under promise to investors, in other words, use conservative numbers in their projections to position themselves to over deliver to investors so that they can build long-term relationships with investors. That's kind of the number one thing I look for. On the flip side, what you're trying to avoid is someone who's over promising, making numbers look better than they are, and to Hunter's point, it's someone who's assuming they're buying it, a property at a 7 cap, meaning they're willing to take a 7% cash flow, assuming no leverage, and then they assume they're going to sell it at a 4 cap. That's an extreme example. that means that they're going to get a much higher multiple for the income than somebody who bought it at a 7 cap. And you have to wonder why somebody is saying, I'm buying it at a 7 cap and I'm selling it at a 4 cap, and that implies someone's going to be able to pay me a much higher multiple than I'm willing to pay. All that says to me as an investor is that the person's being way too aggressive in their assumptions. They're probably making the numbers look better because they're taking an exit value that's much higher than realistic. That they're inflating the ROI. And they're going to attract some investors, but all they're trying to do is probably get the deal closed, make some fees, and then move on to more investors. And you're really not looking for that. That's something you want to avoid. So when I go through due diligence myself, the first thing I do is try to assess the manager's background, their experience. I typically don't like to invest with managers unless they've already acquired several properties under a syndication type structure. And I hate to say it this way, but I just don't like people to learn off of my own money, which is really what it comes down to when you're brand new. And then if they look like they're okay on the experience side, then I'll actually I'll take the opportunity, filter it as far as does it have the type of things that Hunter was mentioning before. Does it have the right preferred return structure? Does it have the right splits that are fair? Does it have the right cash flow target returns that I'm looking for as a cash flow investor? If you're checking off all of these boxes, eventually if the asset itself looks good, then you circle back to the manager and actually determine who you're making a bet on. And so you could do background checks. I would normally ask them often I'll ask 50 to 100 questions about an opportunity or more. One thing that's really key, which a lot of people I think don't understand, is how important it is to read between the lines, both when you're reading the opportunity summary, but also when you're talking to the operator. So just in having a conversation with the manager, by the way, manager-operator sponsor, they're all interchangeable terms, but when you're talking to the operator and getting to know them and asking about the deal, just in the way they respond, using the word like, oh yeah, this is a guaranteed deal, or I'm going to guarantee, it looks like this deal can't go wrong, or hearing all these things from them, just those types of words are saying to you this person's aggressive, they're not conservative. So that's what I mean by reading between the lines, and it can be a lot more subtle than that. You can get a feel for someone being really conservative and how they're answering you just by reading between the lines and hearing how they're answering you. And I would argue the same thing in how their summary documents are actually written. So if you're reading the overview about the opportunity in the business plan, or what I call the offering documents, sometimes you can actually get a feel for someone who's being conservative. And they may say, for example, market rents, I'm just making this up, are $10 a square foot. We assume $8 a square foot in our projections to be conservative. That's a great example of someone who, when you're reading between the lines, you're saying, oh, this person's trying to be conservative, trying to protect the downside, creating some cushion for investors to reduce expectations. And so you have to look for all these different hints as to who you're dealing with. I will say that a lot of investors, especially if you're passive, don't have the ability to do this. I do because I do this full time. But I really it's actually a requirement that I meet with someone in person before I invest with them. And the reason is because you can definitely weed someone out quite well over the phone, but there's nothing like meeting someone in person, because in the end of the day, you're taking all your due diligence, you're doing a gut check, and you're actually saying, should I move forward with this person and make a bet on them or not? And what I find is that the gut check, an important part of the gut check, is actually meeting them in person and getting for the intangible feel as to whether it's someone you want to work with, which really can't be substituted by a phone call, unfortunately.
Right. And then,
so, yeah, I just want to say there's a whole. What's that?
When you back that up with looking at the financial projections and doing the background check and making sure that what your gut check is not the end all of your due diligence, of course.
No. I'm just because I know we have limited time, so there's a lot of more aspects to it. I look at every single line in the projection, see how conservative they are. I'll typically go on site to a property, get a feel for what location it's in. I will verify the comparable sales that they looked at in the reports and the comparable rents to see if they look realistic. You're basically trying to find what's wrong with the opportunity. You kind of go in and say, look, I'm an investigator. Something's wrong with this deal. I have to find it. If you can't find what's wrong with the deal by uncovering every piece of it, then you may want to move forward. But you do have to even though the operator ultimately is much more experienced than you'll ever be at running a specific asset, you're going to want to check everything in there to be sure that they aren't either they didn't overlook important things. You want to confirm that things look right. You're going to want to be comfortable with the opportunity too. Just because a good operator likes an opportunity doesn't mean it's a fit for you personally, like the profile of it. So something might be too much of a value add deal where there's too much risk for you. You may not like a specific type of asset class, whereas somebody does. So, for example, I mean, I'm invested in so many different asset classes, but I'm invested in mobile home parks. A lot of you out there may say, that sounds scary, maybe I don't want to look at that. Even though it's a great asset class, that's your decision, even though it might be a great deal. So to you, what may be a great deal to me may not be a great deal to you for many different reasons. So you really have to be careful and weed through everything.
And when you're going through, and Hunter, I'll ask you this question: when you go through the financial projections of a particular deal that you're looking at possibly investing in for yourself, uh, what are some of the things you look at? I know it's totally different depending on the asset class specifically, of course, but what are some of the examples of some of the different, I guess, assumptions you're looking at to determine if they're being conservative or not conservative on their numbers?
Yeah, I think that Jeremy's point about reading between the lines is critical, especially on this. And I think that way of putting it, reading between the lines, that's exactly the way that should be do if you're trying to do diligence on a sponsor. You're looking at the entire picture and seeing what picture does this paint? What type of personality am I dealing with? Number one, does the executive summary line up with the actual projections? First of all, right? Does the executive summary line up with the legal documents? And if you're looking at all those and they all start to line up, then you can start looking at the line-by-line items in the pro forma. For me, and I do want to get both of y'all's perspective on this, but for me, a very big telltale sign of how aggressive an operator is going to be is the loan. Most of, if not all of, the big bad stories you hear in real estate have to do with liquidity, and a lot of them can be avoided with conservative financing. So for me, if I'm looking at an opportunity and it has a very short loan term, these shorter loans are usually less expensive, okay? Which means they're desirable if you have the capacity to take on that risk. Unfortunately, when you have a shorter loan term, this means you have less time to pay down the principal balance, you have less time to increase NOI, and because of that, you have less ability to refinance if there's some kind of liquidity process. Mm-hmm. Now, both Jeremy and I specialize in recession-resistant assets. These are things like mobile home parks and self-storage facilities. Mm-hmm. We love these assets because they perform during all stages of the economic cycle. The problem with both of those is that sometimes they have issues getting financing because they're not A-class properties in Beverly Hills. So the way that we mitigate that risk is make sure that there's a value add component so that you can position yourself to have more padding in the event that there's a liquidity crisis. What I mean by that is if there's a property that's significantly under market rent, if you can buy that property, raise rents immediately, that's going to add value to your NOI. So on paper, let's say right now we're in a standard or frothy liquidity environment. Banks will typically lend 70% loan to value. If over the term of that loan you are able to increase the NOI significantly, they at the end of the term may say, you know what, we don't really want a loan on mobile home parks, but we'll give you a 50% loan to value. If you've been very aggressive in your leverage, this may be a huge problem. But if you've been conservative in your leverage and added significant value to the NOI, 50% loan to value is not going to require you to take on additional external capital, which is like the #1 fear of investing in something like this. So that's one thing, having a short loan term. Another thing, and this is just another really telltale sign, does two things that you want to be cautious of, is the period of the interest-only portion of the loan. So typically, in commercial real estate, there can be 0 or maybe a 1-year interest-only portion. What this means is that during this portion of the loan, there is no amortizing function, and it's only the interest portion of that. It's only the interest payments. Okay, after year 2, then the loan starts amortizing, and you're positioning yourself better from an equity standpoint. Now, when you have an interest-only portion of the loan, because it's a smaller payment, the cash flow is going to look considerably higher. And I mean very significantly. Sometimes like the difference between 5 percentage points higher, as in if you're looking at a property has a 10% cash flow with an amortizing loan and a 15% cash flow with a non-amortizing loan. That's very significantly different. Some aggressive operators will have 3, 4, 5-year interest-only payments to supercharge the cash flow and make the deal look more favorable to investors, but also it's very aggressive because you're not paying down that loan. Right. So for me, This is just my opinion. If it is 3 years, that's like a yellow flag. If it's 4 and 5, I probably will never look at a deal from that operator again. That's just too aggressive from my perspective.
Yeah, Hunter, I just want to add, I was actually literally looking at a deal earlier this week which I can't remember the last time I saw it. It had a 5-year loan on it. It was 5 years interest only. Now, can you
It's a
imagine
perfect example.
someone's taking a 5-year loan, never paying a penny of it down? And the crazy thing is the cash flows are going to look significantly higher. So an unsophisticated investor will look at that and say, wow, this is a better deal than the other one I just looked at because the cash flows are so much higher. But they're not going to think about the fact that they're not paying down the loan. They may not even understand the fact that they're not paying down the loan. And at the end, the terminal point of that loan, you're in a much higher risk than you would be had you been paying down the loan.
And
So, Andrew, that's a very good point about the loan. And by the way, there's other issues with the loans we can get into too, which is you got to look at whether a loan you're taking on is assumable, whether or not it's a fixed rate or floating rate loan. Right now, I get really nervous when I see some people, and I actually see them quite often because they're very favorable. People are taking floating rate loans, meaning that if interest rates go up, their interest goes up. And let me tell you something, on a commercial real estate property, when you've got a floating loan, that can mean the difference of like literally tens or hundreds of thousands of dollars in debt service in a year. If the interest rates go up higher than you thought, which could cause huge problems. So there's a lot of different aspects to loans, and to Hunter's point, it's a very important point to focus on when you're doing your due diligence.
Yeah, I think especially looking at the timing of the market specifically is really important, especially when you're looking at the financing aspect of things. Because if you do an interest only type loan in that period of time or an adjustable rate loan, you could have some major problems if there's a change in the market. I mean, we're at premium cap rates right now where they're really compressed as far as true cap rates go. And so if you have a change in the market and there's an interest rate increase, there could be major issues with that syndication. So understanding that lending perspective, I think, is important. But also, when you're looking at the financial projections of these things, are they adding value to assume the property value will increase as well? Because a lot of people will just go through and add that increase in value, whether they're increasing value or not, just to kind of keep up with inflation and things like that, versus necessarily actually improving the value of that asset in the long run. And so I think it's important to understand that difference. And I've seen some craziness where people are thinking I'm going to get these much higher rents for putting this renovation in place, and really assuming very, very aggressive financial projections on what they can actually do to that property to improve it as well, which I think that's another key factor, is understanding what is conservative and what is aggressive based on that specific asset class and their previous experience that they've invested with. Some of the operators we deal with on the self-storage side are very conservative on their investments, and it's really important to understand, why they're conservative on those investments and how they are and what different value add they can bring to the table and what they've brought to the table in the past. Just as an example, and that goes for every operator out there, is to understand what their true capabilities are with regard to those. And going back to the due diligence of the operator, I mean, the operator is you could have a really bad deal and have a good operator and still make a good return, and the opposite is true, where a good deal and a bad operator, you could have a bad operator and a great deal and just get destroyed because there's horrible reporting and bad understanding of what they can and can't do with an asset. And so that's where I think, Jeremy, what your point as far as finding people that are experienced on the operation side. I mean, a lot of the people that we deal with on our investments, and you guys too, have 10, 20 years experience in that specific asset class, and understanding and specializing in that specific asset class. I couldn't come in as a multifamily operator and a single family flipper and pretend like I know how to operate a commercial apartment or commercial shopping center, strip center. I wouldn't, I understand them, and I understand what the projections look like, and I understand what due diligence I would do, but there's a ton of things that I wouldn't know as an operator, how to actually operate that and bring the value up, and dealing with the tenants and negotiating the leases, and just as an example, what types of tenants to put in place. And that's another thing, Jeremy, I think you've taught me over a period of time is, when you're dealing with commercial, for example, commercial shopping center, understanding what what types of tenants go into that, and also what type of what technology is going to come around to possibly ruin those tenants. You wouldn't want something where technology is going to take those tenants out in the long run. You want to find something that hopefully is going to be resistant against the technological boom that we all know is coming and continuing to come. So, it's really interesting from that perspective. Jeremy, what do you look at when you're looking at the actual financial projections and the due diligence side?
Yeah, sure. So, some of the things to really look out for on the financial projection side, the number one classic one is, what does someone assume for rent inflation or rent increases over time? And what is somebody assuming for expense inflation, meaning, the cost of living of things going up? And what you're looking for is, did somebody assume that rents and expenses are going to go up at the same rate each year, let's just say 2% or 3%, and they're both equal? Or did somebody assume that rents are going up? I'm just making this up as an extreme example. If somebody assumes the rents are going up 5% a year for 10 years and expenses are only going up 2% a year for 10 years, the question is, why is it that your rents are going up so much higher than inflation for everything else that they're paying for, right? And the answer typically is that they're just being too aggressive, and that's a great sign that you're not dealing with someone conservative. That's definitely one flag that I...
But the returns look great, though. What do you mean?
The returns look fantastic, and the crazy thing is that when that happens, it's actually compounding returns, because the revenues are compounding, the increase is compounding on each other, so 10 years down, it looks even better than you think. So that's one thing you definitely have to look out for in the projections. Second thing, and each asset class is a little bit different, and I don't want to overcomplicate it, but once you get to know the asset classes, you have to look for the subtleties. So, for example, in retail strip centers, you want to have tenant improvement reserves so that when people turn over, because those are shorter-term leases, typically it could be a 3 or 5 year lease, and if you have to assume a certain percentage of tenants don't renew, which is realistic, and you have to have money set aside to help them to improve that space to get it ready for them. That's often either paid for by the landlord, or there's a split. It could be paid for fully by the tenants in negotiation, but you have to have reserves for that. So you've got to see if the operator actually held reserves or not, because if they didn't, the numbers are going to look a lot better. But what's going to happen in 4 years when McDonald's moves out, you're going to find Taco Bell to come in instead, but you're going to have to spend hundreds of thousands of dollars to actually improve the space, and if that wasn't reserved, it's going to be a capital call. A cash call is one of the worst things that clearly can happen in an opportunity when you're having to put money in when you didn't even expect it, right? So that's a great thing to look for as an example in retail strip centers. Whereas in self-storage, self-storage is interesting because self-storage is theoretically probably never 100% full. There's always turnover. You could have a facility with 700 units. It's not realistic to have 100% occupancy, right? Just on the turns. Mm-hmm. And so self-storage often requires incentives to get people in. You guys have all probably seen 1 month free for move-in for self-storage. That's a great example. So the question is, what percentage of concessions and promotions are assumed by the operator in the projections? Are there enough concessions and promotions assumed or not? Because it's great if you say there aren't any required or very few required, but if that's not realistic, the number's going to look better, but ultimately you're not going to get the cash flow that's being projected in the summary. So each one has a different subtlety. Each asset class has a different subtlety to watch out for. And if it sounds complicated to someone who's listening right now, I could promise you that as you look at more and more opportunities, you'll find that a lot of commercial real estate syndications are very common as far as the general things to look for. So, you want to confirm the revenues, confirm the expenses, make sure they look okay as a general high level. But then there's little subtleties in each one you just have to look out for that are different. And I'll give you a great example. For apartments, one very important to look for in the pro forma or the projections would be the expense ratio, meaning that if you add up all the expenses and add up all the potential income or the projected income, what percentage are the expenses versus the income? And this is a quick at a glance you can check this as a test. Well, in a general apartment building, let's say 100 units in an area that's got decent weather, that's not that cold, let's say Dallas, okay, just random, the expense ratio might be 45%. It's reasonable, okay? It could be plus or minus 5%, depending on where it's located, the cost of utilities, who's paying for what, etc. Now, take a student housing apartment, for example. So let's say you're immediately across the street from a state university campus. You got a 100-unit apartment building, even if it's in Dallas, okay? That exact similar type of building should have a higher expense ratio because students tend to tear things up. The turnover costs are higher, and so you might find a 50 or 55% expense ratio, give or take 5%. And so, so there are certain things to look for in each asset class, but ultimately, over time, as you learn, it becomes a little bit easier. So those are just some of the examples of things to look for.
And speaking of the different asset classes, we talked about, mobile home parks, we talked about self-storage, commercial, as well as multifamily. Hunter, are there any other investment types that you like to invest in, and why, if you do like to invest in those, and also why do you like to invest in the other ones we've talked about already?
Yeah, so I have invested in virtually every type of real estate asset class that exists. And the reason for that is I want to be as diversified as possible. And when I say as diversified as possible, I mean that in pretty much every single conceivable way that can be meant. So I mean in terms of operator, in terms of geographic location, in terms of performance during the cycle, which is a key one for me, and just different properties. Right? So if one property or one geographic location is suffering, then the portfolio just continues to generate reliable passive cash flow. So for me, my opinion about my perspective about financial freedom really being about the mindset that goes along with being able to depend on your cash flow. For me, I like to focus on the two that we mentioned, mobile home parks and self-storage. And the reason for this is, generally speaking, all types of real estate assets do incredibly well when the capital markets are loose and the economy is booming. There's only certain asset classes that do well when the economy is struggling. So we talked about mobile home parks a lot. Self-storage is another example. So self-storage, the demand for the product is caused by people that are going through some kind of life change, and a lot of those life changes can be brought on by recession. So typical examples are people having to downside, people getting their houses foreclosed on, people getting laid off and having to move to other markets, or even kids moving home from college. Recently, a study came out that says 50% of college graduates move home with their parents immediately after going to college or after coming home from college, unexpectedly. And the unexpectedly part is the important part, because just generally means that they expected their children to be gone, and now they're coming back, and they have extra stuff that they need to store. So when you have a investment class that the demand increases during recessions, it's going to balance out the fact that what we talked about earlier, the access to liquidity may decrease. You don't really care. As long as you have plenty of room in your loan, and as long as you're operating well within your debt service coverage ratio, if there's a recession and you have a self-storage facility, over the last two recessions, most notably, people have been able to increase their rental income during that time. So while everyone else is complaining, it's not really that much of a problem because the demand actually increases during that. And there's some asset classes that are more favorable during recessions than others. But for me, if you're placed appropriately, your portfolio should be able to perform during all stages of the economic cycle. However, the key to this, though, is investing in the syndicated structure. I don't see how this is possible to be investing in asset classes in which you're knowledgeable in a diversified. Nobody on this call knows everything about every single asset class. We always want to defer to someone else that has a tremendous amount of expertise and has hyper specialized in one particular thing. So
the thing I got out of that was that parents spending hundreds of thousands of dollars to send their kids to school, they're expecting them to have jobs after they get out of school, which there's none. So
yeah.
And so the self-storage is a great way to do that. And to that point, I really, really like the syndication structures, because you can put 25, 50, 75, $100,000 into multiple asset classes in multiple markets around the country, diversified against multiple operators and multiple properties too. So you can actually, if one blows up in your face, you might only have 25,000 out of 500 or out of a couple 100,000 into these different asset classes, which really diversifies your risk. And there's instances where you hit home runs on these because of the value add side of things. And I personally love the value add syndication structure, and I wouldn't invest in something that I didn't think had a value add associated with it. So I think it's important to understand that side of things. Jeremy, what are the different assets that you invest in aside from the self-storage and the mobile homes that we talked about?
Sure, yeah. I just want to touch upon one thing you said, Matt, which I think is important. In general, if you're relatively new to syndications, and I should have mentioned at the beginning in my introduction, but I manage a private group of over 1,000 investors who are looking for passive cash flow. And what I found over time is essentially syndications are best suited for two different purposes. One is for diversification, which is really a huge benefit from my perspective. We all talked about it on the call. I think it's a huge benefit in general. Two, though, is the ability to be passive. And so just like I started when I was in fact, when I started investing in syndications, I forgot to mention this in 2002, I was working at Disney headquarters in Burbank, and I was just too busy to go buy something myself directly and manage it directly. And so the passive aspect of it, especially for people who have jobs right now, or maybe who are even, some of them are even been in real estate a long time and want to stop being active and want to be more passive, the other real benefit is being more passive. So I just want to point that out for those of you who are listening. Now, with regards to asset classes, I'm very similar to Hunter. I'm highly diversified. I'm in currently about 70 different LLCs, and I'm currently invested in right now, industrial property, student housing, apartments, regular apartments, self-storage, mobile home parks, retail strip center, retail enclosed mall, office buildings. That's all on the commercial real estate side, and I'm pretty sure I'm missing some too. And actually, the only thing I can think of I haven't invested in, two asset classes, is hotels. And I stay away from those just because I think there's a lot of good value-add opportunities in hotels, but I just don't. I'm a really low-risk guy, and like Hunter, I like to be protected in a downturn. And so there's a lot of fluctuation and volatility in average daily rates of income for hotels. So I tend to avoid that because in a recession, hotels can go down in income very quickly, and vice versa, actually. And then the other one is assisted living or general retirement communities. And there's different levels of them. There's assisted living. There's different levels. And I have not gotten into those yet. I haven't found the right operator to invest with. But from a demographic perspective, I think those are going to be in huge demand for the next 20 to 30 years, and I'm planning on trying to get into some when I can. But aside from those two, I've pretty much been exposed to all the other major ones. And I've also done residential investing. In fact, I've invested with those of you on the call. I invested with Matt many years ago, many times. I've done hard money, single-family flips, single-family notes, single-family buy and holds, and I'm actually in other non-real estate things too. I have a pool of ATM machines. I'm invested in working well oil opportunities for cash flow, some cash flowing websites, a couple of startups. That's much more rare for me. And the common thread for me is I just look for something that's passive, cash flow generating, and preferably investing in an asset. So that's very different than investing in a business, right? So investing in a business, if the business goes down or it's not managed well, often you just have nothing left. You've got minimal assets. You can sell a desk and some furniture and maybe some intellectual property if you're lucky. The great thing about real estate and why I really love it is that it can generate cash flow, but you typically have the underlying value of the asset, right? So if you invest in a 100-unit apartment building and you want to sell it, you're going to have the underlying value of the building. Even if it's at 0% occupancy, there's an underlying value to the asset if it's there and standing. So that's what I really like about asset-based cash flow investing.
And I think you guys both touched on it a little bit, where you talked a little bit about why investing in different assets based on what you guys are seeing in the overall market and the overall economy and what's happening, and I think that's really, really important as well to understand and be educated about what's happening right now in the overall economy, globally, locally, and industry by industry as well, to understand those different factors. Hunter, what are some of the different things that you look at when you're looking at overall economic indicators to determine which types of investments to kind of focus on?
Yeah, so like everything, it needs to be taken on a risk-adjusted basis, okay? So the first thing I'll say is that if you look at things on a scale when it comes to real estate, you have stabilized assets over here. These is generally 85% or 80% occupied, down to the other end of the spectrum is going to be land entitlement or development, all right, and everything in between. So for me, during the collapse, during the real estate crash, there was a lot of great opportunity in 2009, 10, 11, 12, and 13 in multifamily apartments that were fully stabilized. Just because you could pick them up at such a significant discount because of the liquidity problem that a lot of previous operators were happening. This is particularly true in Texas, right? Texas has seen an incredible run-up in the multifamily prices in that time. And because of that, it's a very low-risk strategy for investing. On a risk-adjusted basis, that's very favorable. However, now that prices have increased, that strategy not only do the returns decrease, but the risk also increase because you're buying a stabilized asset. There's most likely not a ton of room to increase efficiencies and raise rents, and the risk changes, all right? So generally speaking, a lot of people move from stabilized to value add. Now, value add incurs more risk, but the returns generally suit that. And so an example of value add, I mean, self-storage has got some amazing value add components that are relatively low risk. And usually when you say value add, if you're talking about multifamily, for example, let's say you're buying a $15 million property and the operator is planning on putting $2.5 million into the property to turn it from a B-class apartment to an A-class apartment. Now, with that $2.5 million, there's a lot of uncertainty that goes on into that money, right? They're changing amenities, they're rehabbing individual units, they may be adding new buildings somewhere. All of that takes on additional risk. With something like self-storage, you can buy a property that is the most obvious one is not implementing a U-Haul commission structure. So in self-storage, it is very easy. Most top-tier operators are using the strategy to get U-Haul to park their trucks on your facility, and you, the property manager, rent those trucks out and get a commission for that. I have invested in properties where the previous manager was not implementing those strategies. We purchased the property. 18 months later, extra $3,500 directly to the bottom line is being spit out on a monthly basis. So if you're talking about cap rates and value add in terms of equity, $35,000 a month times 12 divided by an 8 cap to be conservative, that's about $500,000. Okay. Another strategy that's similar is forced tenant insurance on self-storage properties. If you buy a property that is not implementing that strategy, that could bring another $1,500 a month to the bottom line. So again, $1,500 a month times 12 divided by an 8 cap, you're adding hundreds of thousands of dollars in value to a property without any capital expenditure. Both of those are nothing out of pocket. So for me, it's all about risk-adjusted basis. I think that paints a clear picture of the type of stuff that I look for.
Okay. And go ahead, John.
So one thing about one of the we've talked a lot about the pros of syndications. One of the cons is that it's from an investor perspective, it's very illiquid, meaning that as an investor, when the first year you've invested, you're not legally allowed to sell your shares in the LLC per the SEC. Okay, so it's illegal to sell your shares for the first year, and then after that, it's kind of hard to sell your shares. And sometimes there's rights of first refusal that are built in back to sell them back to the company or to the current investors. But the point is, it can be hard to find someone to buy your shares. You know, you just might not know anybody who wants to buy your shares. And you can't just press sell on a computer screen like in stocks and have your money 3 days later. So I'm mentioning this because one of the most important aspects of syndications, regardless of what you're investing in, whether it's real estate or other, is thinking ahead, because you're often getting locked into a deal for multiple years in exchange for focusing on the cash flow and wanting the cash flow to come in. So if you're in a deal that's projected to last 5 or even 10 years out, you've got to think way ahead as far as what potential threats are coming up from a technology perspective that could make your property obsolete or some of the tenancy you have obsolete. You've also got to think ahead and think, okay, when is there going to be a recession next time? And do I have to worry about that? And by the way, am I going to buy this property with a 5-year loan in 2013 and there's going to be a recession in 2018 and all of a sudden you're actually trying to refinance in the middle of a recession, and to Hunter's point, there could be no liquidity and no loans you can even get at the time, which is a huge problem. So I'm mentioning this because when you're talking about how what to look for in the economy and what to invest in, you've got to really think a few years ahead if you're going to invest in these types of opportunities. And just to give you an example, like I've been investing since 2013 in anticipation of a downturn. I think a lot of people misunderstand me when I talk about downturns because it sounds like I'm always worried that one's coming up tomorrow. And that's not really true. I am worried that one could be coming up in 3 to 5 years, though, because I need to be sure that I invest in the kind of asset class that's going to do well in a downturn. So just as a random example, if I invest in a self-storage facility, Hunter's talked a lot about them, I invest in a mobile home park, I'm not going to be worried about what's going to happen in those. But if I invest in a Class A office building in downtown Los Angeles that depends on high-end clients who often can't afford rents during a major downturn and have to vacate, and that's a huge problem, well, boy, I better be sure that I'm not going to hit a recession in the Class A office building, just for example. So you got to really think far ahead if you're going to try and mitigate your risk as a passive investor in these types of syndications. Just want to point that out to you.
Absolutely. And just Just thanks you guys both for that. We have a couple of questions I'm going to speed through just because we're running out of time here. One question by Greg. He asks, why do you call it passive? Is it taxed differently than regular income? And it's actually taxed as investment income or via a K-1 that flows through to your personal tax return because you own shares of an LLC. So it actually gets taxed just like any other stock, or if it's rental income that's flowing through to you, then it'll be taxed as rental income, on your actual tax return. So depends on the nature of the investment that you're investing in. Another question, and I'm going to speed through these just because we will be having another opportunity to talk with Jeremy and Hunter and myself, and also another syndication attorney coming in at the end of the month at our For Investors by Investors meeting as well on syndications. And one of them is, Jeremy, how are you able to leave your corporate job solely by investing in syndications? And I'll just answer that really quick for you. It's primarily because he invests in cash flow assets, these types of assets, and he's invested in other types of investments as well that created passive cash flow, that created this cash flow stream for him. Let's see.
Can I just add? I know we're in a rush, but let me just add that and whoever asked that question, and for anybody, I'm happy to, Matt, maybe we'll share our contact information. I'm happy to have a call and discuss anything with anybody. Not a problem if anyone has any questions. But without getting too much detail, when you invest in investments in general, you can invest in different types of cash flow. You can invest in fully amortized opportunities, like when you're investing in a deal that has a loan that's being paid off over time. And that's fully amortized. And then I don't want to get myself confused here. But basically, if you basically have a deal that's non-amortized, meaning you're not paying a loan down like we talked about, or you're getting your money back more quickly because you're getting a combination of interest and principal back yourself, if you're making a loan, for example, there are certain ways to what I call supercharge your cash flow, in that you can have higher cash-on-cash returns per year. The risk goes up, for sure, so you got to be careful with them. But to answer the question, I got out of the corporate world by investing in a combination of non-amortized and fully amortized opportunities. So I had higher levels of cash flow than normal coming out of a certain amount of capital that I had. And then over time, I rebalanced things out and became less risky by being in stuff that had less cash coming back quickly. But whoever asked that question, you're more than happy to contact me, and I can explain that in more detail.
And Ian asked, are the funds secured by a second mortgage or just preferred shares? And typically, what's happening is most of the time they're not they're not secured by a second mortgage. There are some syndications that will do that, and it'll be more like preferred equity. But at the same time, most of these, you are buying shares of the LLC that owns the asset, that has an underlying mortgage on it, and you get a preferred return on your capital before the operators get paid. So it isn't necessarily secured by a second mortgage, but you own the shares of the entity that owns the property in itself. That's typically how it can be structured. So, and then someone asked me if you can rewatch this or replay the recording. Absolutely. We have that. We'll have this recording available. As you guys can also see on the screen right now, we have a couple of events coming up. The first one is on January 26th on Thursday from 6:30 p.m. to 9:30 in Long Beach. And we'll have Jeremy and Hunter and another syndication attorney, Jillian Sidoti, on at the event as well, to be teaching and talking a little bit more about these syndications. And it'll be about a 2.5-hour discussion at that event. So you'll get a lot of questions. It'll be a roundtable discussion where everybody can ask their questions. And that's actually being thrown by Phoebe. And Phoebe stands for Investors by Investors. It's a nonprofit real estate investment club that teaches financial education and real estate education without a sales pitch involved. You will not get pitched anything at any of our clubs. I'm actually throwing another event on January 28th, Brunch and Learn in the morning on a Saturday down in Tustin, just to talk about creating more cash flow from rentals and how to optimize your real estate portfolio. And then in February, we're going to be on the 15th. We have a event in Phoebe Manhattan Beach or South Bay, talking about how to create massive profits from commercial real estate. And so we have a lot of different topics. There's a ton of different chapters throughout Southern California that you can learn from. But this is the syndication one. Definitely go to learn a little bit more about investing that way. And then we have a couple more questions here. Any comments on finding and establishing new relationships with new investors in a syndication, in a new syndication? And I think that's one of the hardest things, okay? doing the homework, finding these relationships, and it really comes down to doing all your homework on so many operators. Jeremy, how many operators do you or syndication investments do you typically vet on, call it, a monthly basis?
I couldn't even tell you. I could tell you like in 15 years, I've probably looked at that, easily over 1,000. I mean, I don't even know the number, but it's been, I basically probably see hundreds a year. And I mean, I'm a one-man show. I mean, I manage an investor group, but I'm still a one-man show. So I'm not a organization. Still look at hundreds in a year.
Okay. And the last question is, how do you find syndicated deals for different asset classes, which kind of relates to the same type of ideal. And really it just comes down to vetting multiple operators over and over again and understanding the projections there and how they work and doing the right due diligence. Both myself, Hunter, and Jeremy do that quite often for investments. So if you want to talk to us and learn how to find these new operators and get to know us a little bit more, we'd be glad to absolutely help you with that scenario. If you want to reach me, you can email me at invest@ocgproperties.com or go to my website at ocgproperties.com. Jeremy, can you kind of give some people how they can reach you?
Yeah, best way to reach me is my email, which is jroll, so it's JROLL at Roll Investments, which is ROLL investments with an S.com. So jroll at rollinvestments.com.
And what about yourself, Hunter?
Yeah, so you can go to my website, cashflowconnections.com. It is an online crowdfunding platform that helps people invest in syndications. And you can email me at hunterthompson@cashflowconnections.com. And yeah, that's it.
Cool. Well, thank you guys very much. Please feel free to go check out our events. You can email me again at invest@ocgproperties.com, and we'll send you a list of all of our upcoming events. You can also go to meetup.com and type in FIBI to find all our events there, or go to forinvestorsbyinvestors.com and find a lot of our different chapters there as well. So thank you guys very much for joining us tonight. I appreciate you guys taking the time out, on a night like this to be able to, really learn and understand syndicated investments. The more you learn and get educated on and your financial education and how investments work, the more successful you'll be. It's a slow, steady process. It took us, all three of us, a very long time to learn what we know about syndicated investments. And so I urge you to continue that education over and over again. Thank you guys very much for your time, and I look forward to seeing you guys at one of the events soon. Thanks a lot. Bye-bye.